Hi everybody, Lance from ThetaTraders.com here. This video I want to go over a strangle strategy, how I managed the recent strangle, the reasons why we do it, and how to calculate what the new take profit and stop loss will be based on our trading rules that we have. It's a pretty detailed video here. There's a bit of math involved in order to calculate the new profit and stop losses. So just stick with it. Try to make it as straightforward as possible here. We'll be doing a live stream on Monday night on a much easier strategy. It takes a lot less time to actually get filled on the order and very little management compared to what we're going to see in this video. So if you're interested in learning about that, there's a link in the description down below. Just sign in with your email address and it will send you a notification with the live stream. All right, let's get right to the strangle strategy. Okay, so here's how we manage a strangle with futures. You can do the same thing with stocks or ETFs if you wanted to, but futures have span margin, very buying power efficient, and you can make good returns on it. So I usually do these strangles with futures. We're going to go over today how to set up the trade and what my mechanics are for setting them up. You can do your own different deltas, different DTE, but I'm just going to explain how I set it up, which I found is a very optimal way to actually get the returns that I'm looking for with the appropriate amount of risk involved. And then also how to manage the trade if it goes against us. I had a recent strangle that had to get managed, so I wanted to go over exactly how I'm managing it. So this is an advanced trade. If you're relatively new to options, it might be a little confusing at times here. So I just wanted to mention that I will be covering an easy, straightforward trade with very little management, and it'll be in a live stream this Monday coming up. If you want to sign up, there's a link in the description below. So first, how do I set up my strangles? Again, there's not necessarily a right or wrong way to do these. This is what I found as one of the optimal ways to do it for the returns that I'm looking for. So on an MES strangle, I'm looking for a premium of 20 or more. It's a 5 multiplier there, so 20 times 5 is $100. Take in $100 in this trade, it only uses about $450 in buying power. You want to leave another $400 or $500 in cash on the side. So you can make $100 off about $1,000 if your initial setup, which is a 10% return. I typically look around a 90 DTE, or at least closest to it, where you could go pretty far out of the money here. Usually it ends up around a 0.06 or so delta. Could be slightly higher or lower than that depending on conditions, but usually around a 0.06 delta on the put and call side, we'll end up getting the 20 premium. You tend to get a little bit more premium on the put sides than the call sides on these. And then my initial strategies for managing it, I'll buy to close it at a 50% profit, which means that I'll be closing at 50% of 20, which would be 10. And that'll be a net credit of $10 in net profit. 10 times 5 is a $50 net profit. To be a 5% return approximately on your money. That typically happens within 30 to 45 days in a lot of cases. So that's a good return and a good strategy overall. I typically stop out at 3x the original premium. Now, this is after the management that we're about to go over. So 3x of the original premium, instead of 20 or $100, you're going to times that by 3. You're going to get out if the mark price is $300 or a 60 premium. And that would be a $200 net loss because we're taking in 100 here, but you're losing $300 when you get out of the trade. So plus 100 minus 300 is negative 200. So this is a strangle I did on June 9th. Filled the strangle, selling one of these about every other Friday until I have at least 4 of these. I like to stagger these out. So when the market's going up, my new strangles will be even higher on the call side. I have some at 48.50, I think even 4900. If the market goes down, you'll be selling lower puts on the newer strangles as well. And this put delta was 0.07. The call delta was 0.06. That was my only open strangle at the time. I have been adding on new strangles every other week. We'll be adding a new one really shortly as well. So if you're interested in seeing how I actually do these trades, I'm going to go to thetatraders.com. Here's how I personally manage these trades. And there's many different ways you can manage it, but this is what I found to be a very useful way to manage to stay in the trade a little bit longer in case it might reverse in direction. If one side of your strangle ends up going to a 0.3 delta, so it's starting to get challenged a bit. It's not in the money yet, but it's getting close to in the money because we started at like 0.06, 0.05 delta. We're going to roll the untested side. That side will already show a pretty significant profit because the market went in the other direction. So I'm going to roll the untested side to right outside the expected move. Expected move is the one standard deviation. About 68% of the time, the market will stay in that range. And I go slightly outside that expected move. So there's still a pretty good chance of that particular side being okay. I know some other traders, like in Tasty Trade Mechanics, they usually go a little bit more aggressive than this. But I don't want the untested side to get challenged very frequently either, because the market could turn and then suddenly you're worrying about the other side of the trade. This also does bring in good premium too. We're going to keep the original 3x of the initial premium that we collected and stop out if it hits the 3x, but we're going to close at 25% of the original profit. So normally we were doing 50% of the original. Now we're going to lower it to 25%. So we want to most likely just get out of the trade here. We're playing a little bit more defense in this case when we're rolling untested sides because we're trying to take in more premium, lower our break evens. So some of the benefits to doing this, you do stay in the trade a little longer if there's continued moves on the tested side. The reason why is you're bringing in more premium on the untested side, and that lowers your break even cost. So that's why you could stay in the trade a little longer if it keeps going on the tested side. If the market does turn towards the untested side pretty significantly, then you would have to worry about that and you might possibly get stopped out as well. But I find that doing this strategy, rolling the untested side, usually the untested side is around 0.02, 0.01 delta. So there's very little left in that particular option. Rolling that out will give you more premium to stay in the trade longer. So what happened on yesterday is I rolled the put side because the market was going up pretty significantly. I rolled the put side on my 37.50, and then I went up to the 43.80 put, and I was right outside and right at the expected move at the time. The market was going up quite a bit yesterday as well, and the market's been going up about 6-7 days pretty much in a row here. So that's going to make one side of your strangle usually challenged. I'm going to close both my positions at a mark. That's the mark dollar amount of $77, or stop out at the mark of $370. So I'm going to go over how to actually get these numbers next. Here's the math to figure out those numbers. So the easiest way to calculate your profit and your break even is to add up your total credits and add up your debits after your management. So here are the steps you want to do is find your initial credit when you first start your trade, find your initial 3x stop, and that'll be your net loss. Usually you're taking in about $100. 3x stop will be $300. Your net loss would be $200. You do 100 minus 300. Then you're going to add your net profit that you got from the untested roll. You are taking in additional premium when you roll the untested side, and just add that up. And then what you want to do is to figure out, look at your initial credit, add the profit from the roll. Then you got to figure out a certain value, that'll be X here. And you want to set that equal to the 3x stop price. So when you do all that math, you could solve for your X value, and that would be the stop loss of the new position. For Y, you can take your initial credit, take your profit from roll, and then another variable you're trying to solve, set that equal to 25% of your initial profit. If you're taking in 20 premium, you'd want that to be at 15 or about $25 gain. So this would be 25 here, and you solve for your Y. So this is the numbers that we looked at from the previous trade. The strangle position, I initially took in $103.75, a little over the 20 premium. 3 times that, or the 3x stop, is 311.25. Now I profited $61.50 when I rolled the put side from the initial put close. If I stop out with the mark price, that's what I'm solving for X here. If it's at 370, then it'll end up being a net loss of about $204.75, which is very close to the 2x of my initial premium, well, really 3x minus the credit that we're receiving. Yep. So it's not exactly at the 3x stop, but it's very close to it. And then for the take profit part, if your mark price gets to 140, you would have taken in 103.75 from the initial trade, 61.5 on the untested roll. Subtract the 140 when you close out the mark at 140, and you would have a net profit of $25, which is close to the 25% that I received in the initial trade. A little bit tricky on the maths. Again, I want to leave this slide open if you want to take notes on it. Uses a little bit of algebra 1 here. I am a high school science teacher. It took me a little time to actually figure out an optimal way to do these. And I'm not exactly like to the dollar on these when I'm actually looking at these trades, but I'm able to get very close to it and reasonable mark prices. Usually I like to get a whole number on the mark price. You may not necessarily get to close it at the exact mark price, but it's usually within a few dollars anyway. So again, this is how I do my management strategy for the Strangle. I have a very detailed written trading plan, exactly when I'm going to roll, and I did roll when I said I would in my trading plan. One of the keys is to be able to know what you're going to do before you start your trade. So I knew that if one of the sides gets to the 0.3 delta, I'm going to roll the untested side and then use those new numbers for my take profit and stop losses. If you have any questions on this, leave a comment down below. I read and review all comments. Definitely like, share, subscribe, all that good stuff. Appreciate all your support and help you out the channel. And happy trading.